Now, we had an interesting conversation with both Punita, Kumar, Sinha and Saurabh Mukherjea on the slowdown, what to expect from the RBI and the overall weak sentiment in the market currently. Listen into that conversation.
The FPI flows that we are seeing in India are not isolated to India. Over the last 1 month, I was looking at the data. A lot of emerging markets have seen outflows. In fact, the majority of them have seen outflows. So some of the outflows that we are seeing in India are perhaps related to the tax fears, but some of them are just broadly in line with investors pulling out of emerging markets, equities. Now, in terms of growth, earnings growth, I'm now putting on my board, corporate board member hat. And I think from most of the companies that I'm on the boards of and the managements that I'm seeing as an investor, definitely there is a lot of negative sentiment. There's a lot of concern that there is no capital available for them to grow. And I think that's the biggest constraint India is facing, is lack of capital. So to the extent we raise taxes on FPIs and reduce that pool of capital from coming to India, that will eventually hurt the economy and the corporate sector. So I think today's discussion, or at least the news that the PMO is at least discussing the possibility of what to do with this FPI tax, is good, because I think everybody realizes, unlike China, India is a capital-starved economy. And if the banks don't lend and the foreign investors go away, then where is this capital going to come from? And how is growth going to happen without any new initiatives, new capex or new investment?
Yeah. Saurabh, on the same subject, and since we talk about markets daily, what is your take on the kind of negative backdrop in the recent weeks? The fact that after today's fall sub the 10,900 mark, we've erased all of our 2019 gains, and the Nifty has turned negative for 2019 now, for real.
So I have to confess that none of us at Marcellus really spent that much time figuring out what the market outlook is, what's going to happen next week or next month. We never have been. Our focus consistently has been to analyze and look for companies whose governance is good, whose accounting is actually bona fide, genuine accounts. Companies who sell essential products and have monopoly franchises therein. So clean accounts, essential products, monopoly franchises. And that's what we spend all our time doing. So honestly, we really have very little interest in knowing what the sentiment is today or what it will be tomorrow morning. And that sort of question is probably best asked to other punters who try to do short-term trading. Our emphasis has been to look after the 500 families whose wealth that we manage, to look after their wealth by focusing on consistent compounders, high-class companies, say the ilk of Asian Paints or HDFC Bank or say Dr. Lal Path Labs, companies that we own personally, and that sit inside the 500 portfolios that we manage for family offices across the country.
Stock markets aside, the larger problem is also the state of the economy. What do you think government can do in terms of a policy measure? Because, even around the budget, there was a lot of talk on whether or not there is going to be a stimulus announcement. The fact that, people were hoping and anticipating that the government would be willing to take a hit on the fisc, and maybe a major stimulus announcement will come in for the beleaguered sectors, namely autos, etc. Now all eyes are on the MPC, on whether or not it's going to be a massive rate cut. The finance minister herself, in her interview to Economic Times just a fortnight back, has also alluded to the fact that she would like to see and is hoping that the RBI would cut rates massively. In light of what the Fed has recently done, a 25 bips cut, which has come in after a long haul of over a decade, do you think the case is now only stronger for a rate cut from the RBI? And can it really materially change things on ground, Punita?
See, I think the biggest challenge is that the government doesn't have money to spend and give a stimulus, because the fiscal deficit, in fact, even at the 3.3% number, is perhaps going to overshoot, and we're going to see a much higher fiscal deficit if growth slows down. So, and if the stock markets and equity markets remain weak, then the divestment targets may not be met as well. So I think the government cannot provide a whole lot of fiscal stimulus like the way we are seeing in China, what we are seeing in other economies. So the only choice they have is to provide monetary stimulus, which they have been providing, but the challenge has been that the banks have not been passing on that liquidity to consumers, to corporates, and so and the NPA recognition norms are still quite tight. So I think they need to make sure that the banks start lending. So even if there's a rate cut, but just because there's a rate cut, I hear a lot of banks saying we may not be able to pass on the rate cut because we have to boost up our own reserves, and so somehow that rate transmission and liquidity transmission has to happen to the corporate sector for growth to pick up. If you look at earnings, I mean, the government, for instance, can't really roll back on a lot of its tax proposals, good or bad. I'm not going to debate that, but the fact is they don't have enough money. And if you look at a lot of corporates and you look at where their receivables are, whether it's the power sector, whether it's infrastructure sector, a lot of companies, most of their receivables are tied to government non-payment. And so if the government starts paying its dues on time, that will release a lot of capital for the corporate sector. And hopefully that will help them then go forward with their capex plans. So I think that's what the government can do short term, is release payments, provide monetary stimulus, perhaps rethink some of the tax initiatives to improve sentiment. And otherwise, we're going to have unemployment rising. As it is, a lot of the companies are looking at costs and cutting costs, because if their top line isn't growing, then they have to find measures to keep their margins stable, or the margins will be under pressure. So I think that's what the government can do.
The point that you made about monetary stimulus, maybe a fiscal stimulus as well sometime later, but the monetary policy, or the policy meet is next week. Do you expect a bigger than expected rate cut? Because do you think a 25-50 basis point rate cut would do something, or they'll have to do a little bit more for a faster pickup?
As I said, I don't think it's just the rate cut. It has to be the transmission of the rate cut and the liquidity. So both have to be looked at. I'm not so hung up on the amount of the rate cut by itself.
Right. And what measures should be taken for a capex pickup, which you mentioned?
See, for capex, I think the main challenge is their demand is weak and capital is scarce. So I think you need to work on both sides, which is why I said that you have to lend. Companies have to borrow and be able to borrow for their projects. But again, capacity utilization isn't very high right now because demand is weak, and demand is weak because there's unemployment needs to be addressed, and the consumer financing needs to be addressed as well. So I think you need to look at all of those things. And if you look at corporate earnings right now, India, we are used to seeing corporate earnings growth of about 20-25%, but now our corporate earnings growth, very few companies are providing that kind of growth. Most of the companies are giving 7 to 10 to 15 at most. So there is a need for earnings to improve, and there needs to be demand that will drive that along with capex.
Saurabh, how would you look at the earnings season? Because after all, earnings will decide where the prices go.
It's been very similar to the earnings seasons we've seen for the last 30 odd quarters in our country, right? If you don't have a capex cycle, you're not going to see anything dramatically different in the earnings season. So I'm not so sure again why people get worked up every time the quarterly earnings season comes around. The economy is has been in slow motion mode for 6-7 years now, and therefore in that context it's it's a little challenging for companies to show decent earnings growth. There's obviously some companies of the ilk of, say, a Pidilite or a Kotak Bank or a HDFC Bank. There are some companies who can consistently chug out good numbers. but their ability to chug out good numbers has been proven a long time ago. You and I don't need to wait for the next earnings season to assess that a Pidilite or a Dr. Lal Path Labs will consistently grind out good results. That's a well-established fact. So what I'm trying to repeatedly highlight is don't look at short-term factors, sentiment, earnings, flows. You cannot really make money by focusing on those sorts of factors on any consistent basis.